All right, Deal Nerds, episode 141. We've come a long way, and this time I thought I would take a good look at climate disasters and the latest trend for climate change to create bigger and more intrusive interruptions into the economy and see what that means for investment. Couple of quick things. We are up to 381 subscribers. Thank you so much for your support. If you're new, please use the playlist that organizes this show in chronological order. And lastly, remember I do not have any magical powers. Please fact check and use your own judgment. Well, I've organized this episode into four parts. First is the market temperature, where we'll see how the market is doing, how my portfolio is doing compared to the market, because I do believe I'm in the minority when it comes to thinking about how to invest. And what does a climate disaster do to the economy aside from creating huge disruptions? And who are the companies that participate in the recovery from a climate disaster to see if there is an opportunity as an investor there? And I'll review my trades and next steps. And most importantly, I want to make sure that everyone understands, climate disaster that you watch on television and say, wow, look at that storm is one thing, to actually live through it is another. And to our folks and friends in North Carolina, Florida, Georgia, the paths of these storms, my heart goes out to you, and I hope and wish for a speedy recovery for you. Well, my portfolio is what I like to call the no drama portfolio. It's that blue line there. There is a little benchmark that even within fixed income goes up and down. Mine is just a steady upward trajectory. And, at least in the last 3 months, my no drama portfolio keeps going up and up, while that line with the jagged path there, that's the NASDAQ. So if the last 3 months are an indicator, volatility is NASDAQ's friend and not mine, and I'm happy about it. The reason my portfolio is the way it is because I am very overwhelmingly in fixed income. And I'm slowly increasing my equity share, as you can see, but it's still a very small rounding error compared to my allocation for fixed income. And even within fixed income, I am overwhelmingly in treasuries and a little bit in investment grade corporate bonds. But even within treasuries, I stay very, very short term. And the reason I'm doing that is, some would argue timing the market is a poor and terrible thing. And my humble opinion is I am going to get into equities. I'm just going to do it after the election and kind of see what the election brings about. So I have a very small allocation in the long end. Other than that, I'm mostly in short-term treasuries. So let me grab my bag of money and my computer to trade and survey how the storms have done and what they have done to the economy and what companies are participating in the recovery. And a quick note, this is from the National Oceanic Administration. Apparently, an average hurricane costs $23 billion of damage, and that is absolutely horrible. And, people in the path of that, their lives are disrupted a whole lot more than just the property damage and having to think about their kids going to college and they don't have a home or their jobs are disrupted. I cannot imagine the personal tragedy that they have to go through, and economically it is 23 billion per event. And the loss, as we see it, has certain concentrations. And the reason I look at it this way is, whether it is a hurricane in the hurricane season or a snowstorm in the snowstorm season, climate change is bringing bigger volatility to damage. And so we have to be very mindful about how to think about it. And investing in the housing sector, if it happens to be around the hurricane path, you've lost a whole bunch of homes. And if you own home builder stocks, they have to restart. Now, you can argue the damaged homes have to be rebuilt, and that comes. But, in the short run, there is disruption to the housing market. There is disruption to healthcare. Your hospital is not going to function if the people have evacuated and they can't come back because there is flooding. The insurance market takes very heavy losses. Your restaurants don't function because there is flooding. And in a snowstorm, it's a different kind of disruption, but these are the industries that take the brunt of the impact soon after the climate disaster. And if you look at the broader side, it costs 22 billion of damage the hurricane does. However, repairing it understandably costs more. So it costs 30 million to repair and 17 billion in labor income. But here is the thing, as we all understand economics, when you buy a car, the car dealer goes to a movie and the movie theater owner goes and, gets some kind of a spa treatment. So there is a trickle effect on the economy. The 22 billion in damage, as horrible as it is, results in 17 billion new labor, 30 billion in contribution to GDP, except it turns around and spurs another 30 billion of spending. And so one way to look at it is, hey, you know what? There is a silver lining. But again, for the people who go through a hurricane, this is not a silver lining, and I fully acknowledge that. And the rebuilding sector, if you will, and if you were to look at who rebuilds and how does it start, the very first place where economic activity happens is in maintenance and repair. And then there is some level of retail stimulation. The housing sector picks up after 90 days, where you try and go back and rebuild. There is new usage of gas and energy in the areas that have been demolished. And then banking shows up to give loans for rebuilding. So there's kind of a little up and down curve. And so there are two sides of the equation. If you're in the path of a storm, and if you're a regional company and your operation is concentrated in the storm areas, watch out. You're in for a rude shock. And if you're a company that is not in the path of the storm, but you get all your input from where the storm has gone through, you also have a huge disruption to your operations. And if you have assets that cannot be moved easily, you kind of have no way to escape from the storm. You're just going to get hit. And so that's the epicenter of a company that gets hit hard by a storm. But on the other side, if you're a larger national operation with some operations in the storm affected areas, but you are the kind of company that can bring in resources from adjacent states, you get to participate in the rebuilding economy. And maybe you also participate in the immediate humanitarian need supplies. And lastly, if you have assets that can quickly be transported out of the danger and you come back and participate in the recovery, then you kind of get to participate in the 60 billion of economic value that is being created. So let's look at Helene and Milton and see what kind of companies that potentially could have been affected, and maybe they did, maybe they did not. One of them that I was following closely is Sprouts Farmers Market. They got away fine, and I'm very happy for them. They have a large number of locations directly in the path of Milton, not as much in Helene. And lucky for them, and I'm so happy for them. Aside from some minor flooding, they did not have catastrophic damage across many of their properties. And Sprouts is a small business. They are growing phenomenally in the market. This would have been an absolute blow to their stock price if Helene came in with the full power it was supposed to. There are REITs that are around growing oranges in Florida. If a storm came in and wiped them out, that REIT cannot recover. You can't suddenly plant an orange tree and have it grow up in 3 months. And luckily, again, they got away. There are trucking companies, some of them did get hit, and I won't mention names. They are very regional. They only have Florida, they only have a couple of terminals. When those terminals get hit, they can't make any money for a couple, 3 months. Of course, they can go to commercial insurance, but that's not what you're in the business for. You're in the business to grow and compete, and their operations get disrupted. And then you start looking at who did well, or who is going to do well. One kind of company that is going to immediately participate in the recovery are landfill owners. You have to take the debris created both by Helene and Milton and put it in a landfill. Many times after a hurricane, the local government gives landfills a lot of leverage in getting rid of stuff, because if you put too many regulations, they just can't cope with all this volume. And so there are out-of-state landfills, in-state landfills. They just want to get to recovery very fast. And so the federal government comes in with the might of the aid and says, let's start cleaning up now. And the landfill companies make out very well. There are damaged roads always. There are road closures that have to be done. There is mechanical, electrical cleanup. There are large equipment rental companies, temporary housing companies. So these are the things that come back to life very quickly. There are companies that fix power lines, and they are, fixing 3.3 million households that are out of power. And so if you're a value investor surveying this kind of damage that has happened, then you start looking at where is the highest economic activity in the 90 days in the aftermath of a natural disaster. That would be companies in debris removal, lane closures, rescue operations, road repair, glass repair, electrical, trucks, and so on. So I thought I would share some of the companies that I researched. And so we're going to look at companies that are regional to Florida and North Carolina, and companies that are national but can very easily expand into those areas in those select areas. Now, I am a value investor. I will always look for a moat. I will always look for low debt. I will also, those conditions don't disappear. And so, using all the value lessons we have learned and not overpaying for a stock, so their PE ratio has to be reasonable, price to cash flow has to be reasonable. So, I'm going to share with you select companies. And before I do that, I want you to know this is not investment advice. I'm sharing my education. It is not, wealth management advice. I'm not a wealth management advisor. I don't do politics. I'm not pitching any product. Please keep all of that into mind. And here we go. When it comes to debris removal, there are many debris removal companies that operate in Florida and North Carolina, and Republic is one that has the lowest debt to equity ratio. Even at the lowest, they are at 100% debt to equity ratio. That's obnoxious, but that's the best of available solutions there. And as you can see, their stock price over the last 5 years has done very, very well. Stock ticker RSG. And I like revenue and I like cash flow. And you can see that they are able to sustain that high level of debt and deliver phenomenal and increasing earnings per share and revenue. So I like RSG, Republic Services, that does debris removal, and they will participate in the economic recovery and do well. Lane closures, you go through these highways and you get these concrete blocks that are on the side and the cones, and you're sitting there going, oh my God, there is a storm, they are digging a trench on the side. And turns out there is a company that owns a patent on those lane closure J-hooks. That same company also owns a patent on these walls on side of the highway. And those walls are sound absorbing walls, and they give the local municipality on the other side of the wall permission to sell county land or city land adjacent to a highway because they have abated highway noise. And so the city makes real estate taxes. So it's a very interesting solution to a city that says, I can't sell land next to the highway. And this company comes in, sells them noise abatement, and the city makes real estate tax revenue, and the company makes this revenue. And that company is Smith Midland, SMID. Please note that there isn't a lot of float from Smith Midland, meaning only 40% of the total shares are trading. And so there's a little bit of volatility there. The spread is high, but they post really nice revenue growth. Their cash flow is up and down, in part because, as I told you, because a lot of their float is not in the market, management has a lot more leeway on how to use cash, and I'll leave it at that. And you make your own conclusions, read their quarterly reports, and I'll post links to all of those on this episode. The next one, you need tow trucks to come in and pull those vehicles out of the storm. So who makes tow trucks and who does it well in a good share price? Turns out Miller Industries, MLR, is a zero debt company or a minimal debt company that has excellent cash flows. Their stock price has done very well. And look at their earnings per share and revenue. Absolutely stunning performance. And Miller does a really good job in both of these areas. They sell tow trucks of every shape and size. As you can imagine, the storm wiped out an inventory of tow trucks as well. And so new tow trucks need to be bought by these cities and municipalities with federal aid in some cases and without in other cases. And so I see that as a company that is going to participate in the recovery, and I own their stock. Then you go to rescue. There are fire trucks that have to be carted in. There are these rig-looking machines that have to lift things, demolish homes, rebuild homes, ambulances, and that's a company called RevG, REVG. And RevG posts again revenues that are just fantastic. Their earnings per share hides reality. If you take that one aberration out, it is a steadily increasing earnings per share. Then we go to road and glass repair, and this is my all-time favorite, USLM. They mine lime in several states that are very rich in lime, and they ship them nationwide. And lime is something that cannot go too far, so you have to have a local supplier. And as you can see, their stock in the last 5 years has gone up by 10x, and the revenue and cash flow tell the rest of the story. They're having a jolly good time. That's USLM, and they will certainly participate in the recovery in these adjacent states. Then you have to go look at power. And here is a company called Organ. Organ builds new power plants, but they also have a services side of the house that buries power lines. Any of these municipalities where they had overhead power lines and trees fell and they broke the power line, there is a short-term repair, which is to, put the power line back, but the long-term repair is to bury the power line. Organ participates in that. Then the Organ's revenue tells you the rest of the story, an absolutely steady increasing revenue. They do build new natural gas and solar and nuclear power plants. So there's a lot of that happening with the data center and the AI. And even without AI, Organ will be participating in building new natural gas power plants, is my opinion. You do your own research. The next part is the people who come fix the broken power lines, the people who come fix the mechanical, the plumbing. And rightfully, their ticker is called FIX, F-I-X, a very cool 800% increase in stock price. And you say, well, why did that happen? You look at their revenue and you look at their earnings per share and you go, I see why. And so FIX is another company that is most likely going to participate in the recovery from these storms. And then the next part is trucking. There is an interesting thing that happens to trucking. The cost of moving 1 ton per mile, that is how they measure trucking industry, that rate is going to increase because trucks will take longer to go 1 mile in the aftermath of a storm. And Saya is a company that I believe will participate in it, whereas the rest of the trucking industry sees a decreasing revenue per mile per ton. Saya is seeing an increase in that, and they recently bought a whole bunch of terminals from Yellow, which went bankrupt. So I see a lot of good things happening for Saya. Their revenue is always on the upside. They just made an acquisition. They do have loans. They do have a convertible note. And having said that, I like Saya, and I did buy some of them. Last but not the least are school buses. Well, school buses also get flooded. They also get damaged, and there are many diesel school buses. And the federal government says, hey, you take out a diesel school bus and you put in an electric school bus, I'll give you a couple of bucks. Then you have to say, who makes school buses? Turns out Bluebird. Bluebird makes a majority of school buses, as do a few other companies, but Bluebird is pretty dominant. And Bluebird also shows they went from a loss to a profit. They increased the price of their school buses by 25%, and they're still selling a lot of them. Must be really nice for Bluebird these days. And so those are the kind of companies that come to my mind. I inform myself. Please do your own research. So here are my trades. I still am buying short-term treasuries that mature on the nose of the election or right after. And so as you can see, this is November 5th and 21st. As far as equity, I bought pretty much all of the companies that came up in this search. IDR is a gold mine. I do buy them here and there. Here is Republic, here is Miller Industries, and Rocket Lab, and so on. Here is Fix. So these are all names that you just saw, USLM, Saya. And so here is where my portfolio is, and there is Organ and Bluebird. My portfolio is up about 12% on an average day. I have an offset, and gold goes down when the rest of them go up, and vice versa. And so at the end of the day, I have the equity allocation I do. They are all in value sectors. I have a couple of pharma. Other than pharma, I'm in food, gold, war, and then the storm recovery stocks that I recently acquired. You do you, and please share your thoughts with me. And I love to learn. And thank you for watching Yield Nerd. Remember, even a broken clock is right twice a day. So make sure you do your own research. Thank you for watching Yield Nerd. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.